The next ratio that you'll likely use in your role as a bookkeeper is the operating profit margin. Like the gross profit margin, the operating profit margin tells you how much money the business makes per dollar of revenue it generates. However, this ratio focuses on the money that was made after the business expenses are factored in. By knowing this margin, a business owner gets a better understanding about how things like overhead and other operating expenses impact the profitability of their company. If profitability is low for their industry, then the owner can start looking at their expenses and start to work to find areas to cut costs. Now, there isn't a business in the world that runs without some sort of operating expense. So let's take a look at how to calculate the operating profit margin. Let's take a look at Claire's income statement again. To figure out her operating profit margin, we simply just take what her total operating earnings were before taxes and divide that by her sales revenue. That will tell us what percentage of every dollar Claire keeps once her overhead is factored in. Let's see how things shake out. Looking at the numbers here, this means that once Claire pays her operating expenses, she is keeping roughly 38% of every dollar as profit. Still a pretty solid number. Let's sit a spell and get some advice from our expert.
So we've discussed our gross profit margin. So now what is the operating profit margin? The operating profit margin is going to be the gross profit margin, revenue minus cost of sales is your gross profit margin. Now we have all the expenses that we keep up with that actually help us keep the doors open. Utilities and overhead, payroll, professional services, dues and subscriptions, all of those other types of expenses subtracted from gross profit margin gives you the operating profit margin. Again, there could be ratios and numbers, percentages that we're looking for to hit either seasonally or overall through the year or for each month. And so those are targets that we want to meet. It is extremely important that there should be some profit at the end of the operating profit margin and not an operating loss. So we definitely want to see that there's a profit and a percentage that they are hoping for or that they need to get to be able to meet the business needs. This explanation, understanding how to look at their profit and loss statement, looking at these margins where they are seeing a gross profit margin that they're trying to hit and an operating profit margin that they're trying to hit is one of, I think, the most important things that we as bookkeepers can do for our clients, because it is something that many of them do not truly understand. And reading financial statements, explaining this in a really simple, clear, relatable, usable way for a business owner is just one of the most valuable things that we can do for them. A lot of our clients are overwhelmed by these numbers, so explaining it is really important. So again, the operating profit margin is going to be, if you had $1,000 in sales and $300 in cost of sales, their gross profit is $700, 70%. And then they have operating expenses. They would be deducted from that. Let's say that's $400. You end up with $300 as your operating profit. That would be a 30% operating profit margin. And that's typically what we're looking at with our clients, trying to get to those goals. Sometimes they're called a budget. And that's what we're looking for to help our clients with.